right, let's kick it off. This is a capital markets assessment. We've got a great team of advisors here as well as an investor. So we've got Ramey, who is a partner at Vincent & Elkins. We have Craig DeDomenico, managing director at Stifel, and Nicholas Petruska, who's a partner at Vine Hill Capital Partners. I'm going to start off with Ramey. Ramey, so we're going to do a lot of forward-looking discussion here, but given the recent lack of activity, although Tad, again, yesterday said the market's very healthy, it's not as healthy as it was, certainly. Does that impact the SEC review process of your clients?
I mean, I think the SEC review process has been protracted, more so than it has, I think, ever. The number of times when the SEC doesn't meet their stated policy of turning around a review in 30 days is remarkable. I mean, I think before this past year, I'd probably seen it once, and now it's almost like every deal that we work on, the SEC takes longer than they're supposed to either review a first filing or to review an amendment. Now, I don't know if that's so much a function of them having so many filings to review, or it's that they're doing so many other things, assisting in drafting regulations or the like. But it certainly seems like they're going slower than they're supposed to.
Well, that's interesting. I mean, obviously, when there was a deluge of deals, it was understandable they were so busy a few years ago, right? But now that's not a good excuse, right?
Well, I mean, they still have a fair number of filings that they're reviewing, but it is an interesting question. I don't know if they're understaffed or overworked or both, or they just feel like they can, sort of violate their policies. There was a comment from an SEC staffer this morning. The SEC does a SEC Speaks PLI every year where staffers and present, and they commented that when they have a lot of filings, they just give fewer comments. It's almost like they felt compelled to rush them out and not give them as fulsome of a review. But so I don't know.
That's interesting. Well, then, if you are contemplating an IPO, how much time should you be allocating to drafting that S1?
The S1 drafting is, if you had financials ready to go, which is the big caveat, that's usually the biggest time suck. 2 months would probably be leisurely, I would say. That gives you plenty of time. But it varies case by case. If a company has issued high yield debt, their disclosure, that document's going to look just like an IPO. So you can kind of crib off of that. If you're doing a first of its kind of company, that's going to take you a lot longer than if you've got a public company peer that is basically the same company and you just, you start with that. So it varies. But, usually I'd say if you give the lawyers a month, that'll give you time to have the necessary back and forth in drafting. But, I'd budget 2.
Gotcha. All right, let's talk about the market. So after Election Day last week, markets soared, and I've spoken to a lot of people who said that the election results are very bullish for IPOs. But I just want to dissect that a little bit because the market was basically already at an all-time high, so it's a little bit higher. But what specifically about the new administration is good for IPOs, if anything? Maybe Craig?
Sure, and obviously thanks to John and team for having us in this beautiful view, and good to see everybody. I would just say that the markets in the last quarter or so really haven't seen a demand problem. It's really been more of a supply problem. So I think what the recent announcements have done have obviously given more sellers of assets confidence that there's going to be a really strong window in 25, and therefore, to Ramey's point, get ready to be ready is kind of what we always tell issuers. And I would take the over on 2 months. I would hire Ramey immediately if he can go that fast. But we we agree that processes. And then in general, if you think about the majority of the IPOs, it's coming out of the mid-cap, small-cap universe, right? Those companies are the most likely to be domestic. They're the most likely to benefit from tax policy, which is pro-business. And as a result, their confidence in projecting their forward numbers and the impacts of that is important. It's also a confidence topic, right? The IPO is at the high end of the risk curve, so if consumer and business confidence is higher than it's been in a long time, then it would make sense that the IPO market really start to pick up, and I know we'll talk about that in a bit.
That's a really good explanation. Anything to add to that, Ramey? You largely agree. Do you largely agree with that as far as the election impact?
Yeah, I think so. I mean, I think this past year, if I look back and think about the deals that I've worked on, there have been IPOs, there have been opportunities, there have been windows, but they've closed quickly. So, it almost felt like you had to be ready at exactly the right time. And so there were lots of companies that were sort of saying, well, we wish we'd gone public 3 months ago when our peers were trading at X, but now we're going to wait because they're down at 60% of that. So it's been streaky is probably the way I see it, at least.
Gotcha. Oh, just one follow-up on that, macro forces. What about inflation and rates? Is that, I feel like there may still be some question mark over that. How are we looking at that?
I can start there. I think what recent announcements have shown is that the rate curve is steepening. If you're waiting on your financing because you believe we're going to get future rate cuts, you're probably starting to feel like, okay, we've sort of gotten the benefits of those now, and it's probably time to start to energize that. A lot of companies stayed private longer than we would have expected, simply because they got the benefit of a more robust leverage finance market and the ability to take advantage of rate cuts. I think as we look forward now, they'll start to look at the benefit of equity and the ability to pay down debt exposure against a rising yield curve. So I just think it'll kind of kick people to move, and the benefit of that is probably in the rearview mirror.
All right, great. Let's bring Nick into the fold here. So, Nick, some news from you. A few months ago, you had a successful SPAC IPO. Not many of those going on, and I'm just going to say this rather than have you say it. I think a big reason you were able to do that was because of your long-standing track record with Hennessy beforehand. Tell us what it was like doing a SPAC deal and how it felt compared to one of the the vintages back in your Hennessy days.
No, thank you for that question, John. So yes, we're Vine Hill Capital Partners. We're a serial SPAC sponsor. While we're a new firm, our team actually has 30 years of cumulative experience in the SPAC asset class and 13 completed deals. So a lot of people know SPACs for that kind of 18-month period of market euphoria we went through in 2021 and 2022. But our team has been doing it for a lot longer than that, so I think we have a much longer purview than most. And going to your specific question, it feels much more like the right time to be in the SPAC asset class. I think there was about 600 SPAC IPOs in 2021. That compares to a more normalized market of about, call it 20 to 50 SPAC IPOs a year. So we were way oversaturated. The market feels like it's about to be just right. And I think timing is also perfect, which is why I think you're seeing a lot of SPAC issuance right now. I think the theme of the first 2 months that we've been in market has been stuck. Whether you're a company looking to sell, the sell-side M&A market's been very challenging. I've heard kind of the sponsor trade is dead. So unless you're one of those lucky few companies who is attractive for a strategic acquirer, it's very hard for companies, and particularly sponsor-backed companies, to get liquidity at a reasonable cost. We just talked about the IPO market. The backlogs of all-time highs. Many of those companies have been in the queue for, call it 2+ years. And some of them are starting to look for alternative means to the capital markets. And then if you look at growth capital raises, those are about 50% of historical levels. So we think right now the reason you see a lot of SPACs coming to market is because the SPAC can be a unique solution for companies looking for liquidity for secondary proceeds for shareholders or growth capital, or those who are looking for a more certain path to the public markets than maybe a regular way IPO can provide.
Gotcha. So, wow, I didn't realize that the volume was, see, we're talking less than 10% of the peak level. Wow. But my other panelists here, would you agree that's probably healthy? You don't want 600, right?
No, I think everybody and their brother had a SPAC, and there were way too many. There was no way that the market could digest that many companies going public via SPAC. And the level of sort of overconfidence of management teams that they were somehow different and they would be able to get a deal done when there was so much competition was just sort of unprecedented. So I think I like the 20 to 50 level. I mean, that was where we were in 17, 18, 19, and it feels like that's digestible. You can get that many deals done. Now, not all those deals are going to be great, right? A lot of them will have high redemptions right now, but it seems like you can at least, there's enough supply of private companies to go public that way, I would say.
Great. Let's shift gears and talk about convertibles for a moment. Maybe Craig can jump in on this one. Craig, what's going on in the convertible market, and are there ways to do convertibles on a pre-IPO basis?
Sure. So the convertible or the equity-linked market generally benefits in rising rate environments. So we would expect issuance there to continue. It's been busy this year. In fact, we've had some investment grade issuers come to market for the first time in many years, and part of that was to term out, floating rate revolving debt as they were looking at, the curve, continuing to change. And there's been a bid, but I would just say that, as you think about growth businesses and you think about, moving into the debt market, whether you're a growth business that wants to have debt but not have bank debt and live with maintenance and financial covenants, then that's a great route of subordinated debt. If you're a company that has historically financed in the term loan markets, but you want to have a tranche of subordinated or unsecured, that's also healthy. That also exists in the private market. As we think about the pre-IPO rounds, we don't necessarily look at it as convertible or non-convertible. We look at it as what is the timeline to a potential IPO as it relates to that pre-IPO capital. And if we have confidence that in the next 12 to 18 months, that company is likely to get public, which has obviously been a much more realistic topic in the last few months than it was in the last few years, then we think that we can, put a wrapper, either registration rights or some form of subordinated convertible structure that will enable those companies to raise capital so that they can get their capital structure ready for that eventual IPO. And I would just say the amount of those dialogues in the last quarter or so has increased dramatically as people have increased confidence that 25 is going to be a good and solid IPO tape for people to issue into.
Great. And then just one more follow-up on this. What about post-IPO? How soon after an IPO would you advise a client to consider doing a convertible?
So it's obviously sector dependent, but I would just say for the first year of a public company's life, they're under S1, right? So as a result, they don't have access to a shelf registration statement. So your options are to raise capital in a S1 follow-on in a 48-hour period, open market, or you could consider doing a 144A convertible debt offering. So generally we would advise report a few quarters, but once you get past that 180-day window and you're in that kind of 180-day to 365, we think the unsecured convert market could be a viable product.
Switch microphones. Sorry about that. Let's go back to Nick for a second. Nick, I skipped a question I wanted to ask you. So compare, if you can, I assume you've had some meetings with potential targets now. How does it feel when you take those meetings compared to when there were so many SPACs out there? Is it easier to get them? Does it feel like since there aren't that many SPACs out there hunting these targets, does that lean in your favor? How does that feel?
Yeah, I think right now, as I kind of alluded to before, and it's fun to finally say this for a change. It's a great time to be a SPAC sponsor. I think the number of SPACs out there certainly matters. As we just discussed, the market was way too oversaturated. So being one of the few ones out there, and especially one of the few ones out there that has a long track record in the asset class, has been a big competitive advantage. But candidly, I think what's getting us all these shots on goal is not just that there's so few SPACs out there, which certainly helps. The biggest thing is, I think, just the general state of the capital markets. And I think everyone's very optimistic for what's going to happen next year. And I agree. I think there's going to be a lot of activity. But given the queue that's built up over the last, call it 2 to 3 years, when market activity was much lower, only a certain amount's going to be able to make it out in some kind of reasonable time frame. And I think the SPAC is an option out there. For companies which may not be your A-plus, really sexy tech IPOs, but still not just great companies, great public companies, that we are a viable alternative to the IPO or other more traditional solutions.
So presumably you're still looking for growth companies, but maybe not a tech growth story that looks like it could be a regular way IPO?
I think, we look at things opportunistically. I think our focus is much more on mature cash flowing assets. If you go to the first SPAC I was involved with Hennessy One, we did a deal with a company called Bluebird. It's a school bus manufacturer. If you see a school bus on the road today here in Florida, there's probably north of a 50% chance it's a Bluebird school bus, and that company is quite literally almost 100 years old. I think they celebrate their 100th anniversary in 2 years. So I think it's hard to get much more a mature company than 100 years old, and it's one of those ones which I think would not have been a obvious IPO candidate, but it's a great company and it's been a very well-performing stock since we brought it public.
Craig, I can ask you a similar question, I guess, because, Craig, obviously there are some banks that stop doing SPACs at all. There are a handful that are very active. How does that work out for your team?
Yeah, I mean, I would just say we view this SPAC as a helpful tool to the capital markets. We share the views of Ramey and Nick that you don't need too many of them, but we really look at it as a comparative to not just the auction-based IPO, which a lot of people compare it to, but also what was for a long time discussed as this big direct listing market that was going to develop, right? Everybody was going to do a direct listing, work around the auction-based model. And we think that the SPAC, if right-sized against a target company, can provide an efficient level of dilution where it provides a company an opportunity to get listed in an alternative way. And that's really the way we think about the business. So from a broader cap markets perspective, my partner Alyssa, who runs that business for us, she sits within ECM. We talk to a private company about, do you need to raise pre-IPO capital? Should you do an auction-based IPO? Should you do a SPAC IPO? What are your other alternatives? Should you stay private and do a debt deal? So we look at it as a tool in the quiver. And for many companies that aren't necessarily doing the IPO because they need that fulcrum capital or they don't really need to be overly diluted at the IPO, the SPAC provides an alternative to get public in a way that they can design a little bit more creatively than we could otherwise do in an auction-based IPO where that's been tried and true. It's not going away. As we said, that's going to be a viable path for a more realistic number of companies. But as Nick said, we really like partnering with SPACs like Vine Hill that have history in the product, understand what it could be. And we also think that companies with, significant EBITDA levels, that the SPAC can be an alternative to an auction-based IPO, and they should compare both as they think about that option.
Great. Now, Ramey and Michael Robbins are going to dig deep into the regulatory impact of the election on the next panel, but I do want to ask you, Gary Gensler's mission to take down SPACs, I mean, he's out, right? So what's going to happen with that? Maybe Ramey got a thought or two?
Well, I'm not sure there's a lot of people who were defending SPACs against the disclosure changes that Gensler proposed and then adopted. I would, and largely what he was doing was codifying prior practices. So there's a few things incrementally in the new rules, but I would be surprised if a new SEC chair, even on the short list of things to do, would be to roll back the SPAC regs. I think those are here to stay, and they're not. There's a few things in them that are painful to deal with, but for the most part, they don't really change much. Frankly, the uncertainty that we had when they said we're going to, have these rules, and then it took them a year and a half, 2 years to finally propose them and get them adopted. That uncertainty was the bigger issue, and that's gone. So I don't know. I don't see much change there.
Gotcha.
And I would definitely second what Ramey said. As a sponsor, we welcome regulation. The regulation, as Ramey said, was generally codifying best practices. So it's something I think the top tier sponsors were already doing. So I think it leveled the playing field among sponsors and eliminated all the ambiguity that was out there. So I think it was generally a good thing.
Gotcha. Now, I know that I've been asking you guys for a couple years to predict when the window's going to burst open. We dug into this a little bit. Trump is positive, but as I recall, correct me if I'm wrong, maybe Craig knows this off the top of his head, January is usually pretty slow for IPOs, right? So maybe can you take a stab at which quarter we're going to see the uptick in?
I think if you asked every capital markets head across Wall Street, they'd tell you that every company's coming public in the second quarter of 2025. It's not going to happen, but I don't disagree. There will be a lot of them. And the reality is the 10K filing, always becomes, an inflection point. I do think there will be some companies that, look to go out in that January and before their numbers go stale window in kind of that Feb 12th area. But those will be companies that either don't report on a year-end cycle or want to go off 9/30 numbers with recent developments, and they're very stable financial stories. But I would say the majority of those companies, we're hearing a lot of second quarter of 25. We're hearing a lot of, first quarter of 26 for a huge number. I mean, hundreds and hundreds of companies. I don't think anyone in the room understands the magnitude of the amount of private filings that are currently, on with the SEC and thinking about the IPO as a viable exit. All those will not make decisions to move forward, but I think it obviously sets up for a very busy 25, but I want to caution 26 will likely be bigger than 25.
Are a chunk of those companies, have they been in that spot for a few years? Have they been keeping their numbers and filings current for quite a long time?
Yeah, I mean, I could speak to our backlog being at a record, and a lot of clients that we not just need to win the mandate and help them get to that point. We then need to make sure we stay on top and talk about, what their alternatives are, because, agendas change, goals change, projections change, and an IPO can be the best idea, and then maybe something else is an alternative. But I would just say not every private filing is being kept current on a quarter-to-quarter basis, but I would say the energy and discussions around starting to get that process energized again has picked up in the last 6 months. And I think obviously Ramey can speak to that, from the legal side as well. But we, as I said, be ready to be ready when, if you want to go in the second quarter of next year, we're actively talking about updating filings, making sure financials are ready, probably planning an analyst day, for later this year or in that January window next year, to make sure everybody's aligned and ready. And there's also been changes in syndicates, like, to a certain extent, banks don't stay the same for, 3-5 years either. So to the extent, things have changed, the bankers left, research analysts have left, there's also been discussions about maybe relooking at syndicates on filings that have been out there for a while, or to consider new alternatives like SPACs, as we talked about earlier.
What else might impact companies? I mean, for one thing, I feel like 2024 deals have been a mixed bag. Maybe I'm wrong. Have they performed? You probably know this off the top of your head, Craig. The 2024 IPOs, how have they done?
It's been, it's been generally solid. I think, obviously a good portion of those are coming out of the healthcare and life sciences community. So those always have a different return profile generally. But I would say we're comfortable with the way, IPOs have performed so far in 24, but we'll need a much larger supply data set to really say that, we're back. And I think it's still going to be a situation where companies really have to have a reason to go public, and they should expect that their projections will be analyzed in a lot of detail by the investor community to make sure that there's confidence in those numbers, and that the day one value is appropriate, and that there's an IPO discount that works, under a bunch of different scenarios.
Gotcha. Is maybe being profitable is a nice to have. It's not a must have. Can you go public in 2025 if you're still losing money?
Yeah, I think sector to sector. I think there will be IPOs we'll see in AI. There'll be crypto is going to continue to pick up. So there will be companies that are going out based on either a rev multiple or a forward DCF for sure. But I also think you'll see a lot of mature businesses continue to come first in 25. And I think if the mature businesses get out and they do well, then you'll see that second wave in 26 where we'll see a larger rev multiple context. I think tech will be back, but I think it's going to be more 26 than 25.
Ramey, what do you think? Agreed?
I mean, I think that's right. With the right AI name, you'll be losing money for what, a decade maybe? I think that's the math. But if you're losing money and you're in a more traditional industry, I think you're going to have a hard sell. I would guess.
Is there anything that you could point? I mean, look, when we're talking about the frenzy a couple years ago, and it wasn't just SPACs, right? There were probably companies that did regular deals that shouldn't have done them. Are there mistakes that were made that your clients can learn from, guys? You say like, look, that was bad, don't do that, et cetera.
I mean, it's so hard to teach people from other people's mistakes. You see a lot of hubris out there where we're so much better than our peers. It's really hard to find a humble management team that's successful. So I don't know. My view is it's really hard. The most mistakes that I've seen people learn from are when they say, "I'm so glad I didn't go public last year because we had such a bad year relative to what we showed the analysts in our model." So it's more learning from your own mistakes. It's beyond that. I don't know. Maybe I'm a little too narrow-sighted.
You know what? Actually, we're going to have Hotel Planner here. I interviewed Tim Henschel, the co-CEO. We have the other CEO in late this afternoon. And what Tim told me was that they spent several $1 million on the process going public. And they are very happy they didn't, because they said that their peers, that did SPAC deals are trading at $1. So that's interesting, because that is them. I don't know if that was a mistake, but it was, a lesson.
I mean, that's the thing is like, you don't see projections in the IPO, in the public disclosure, but they're very, very important. And so, the company and the analysts spend a lot of time discussing them, figuring out, okay, what should this model look like? And honestly, that's probably where people learn the biggest lesson.
Yeah, you need to take a view that, mostly if you're focused on the monetization aspect of an IPO, you need to take a view that, it's going to be a 24 to 36 month process, right? If you want to sell 100% of the company, just go sell the company, right? And you'll figure out what that bid is. If you want to take it public, you're likely selling somewhere between, 15 and 30% of the company. So the remaining, shareholders are still going to be long that trade, and they need to be really careful about the way they approach the market. We obviously want to get the best price for our clients, but we also want to advise them that, leave some room on the table for you, for uncertainty, for changes, both financial markets, geopolitical, others. Like, you want to make sure you leave yourself some cushion, in those early phases so that you can build confidence with the market. I think there will continue to be investors, even for the better IPOs, that will wait on the sidelines, watch the company report a quarter or two, and then make a decision about stepping into the stock in that second half. Or they will take a toehold position at the IPO, maybe buy 3-4% with a goal to get to 10% over time, but they will buy, in. I don't think you're going to be seeing situations where people want to, have a max purchase at the IPO, because they want to make sure that the companies are tested in the public market. So that's I guess the best approach.
Gotcha. I've got a sector question for you guys, then we're going to open up to questions for the last couple minutes. During the frenzy, the bubble we were talking about, if I can call it that, it coincided with a big, bubble, if I might call it, an ESG as well. So you had a lot of green companies, and there would be 3 pages in each deck about their ESG and so on. Under the Trump administration, I mean, is there any? Do you see those kinds of companies? It's ironically, J.D. Vance was on the board of one of those companies. I forget what it was called. It slipped my mind. It was a SPAC. Those tomato towers they were going to build. I think it was a zero. But are we going to see more of those companies coming out?
Look, I think during that period of euphoria we've been citing, I think there was a significant ESG premium placed on assets. I also think from an investing perspective, there was a lot more willingness by investors to underwrite what they were calling a green premium. So maybe the product didn't make economic sense, but they assumed that the end user would pay a significant premium just to say they have a green solution. I think the market's moving now to a much more healthy place where people will still focus on these ESG portions of the business, but only where it actually makes business sense to do so. So I think people are no longer willing to underwrite to people paying an unnecessary premium to have a green product, as much as saying, hey, if this thing which is ESG positive also is really helpful to the bottom line, maybe improves TCO as an example, that's something they're willing to underwrite to.
Great. Anyone in the audience have a question for our group here? Yes, sir.
These companies that you're referring to about going public, are they being driven by income, profit, cash projections, where they expect to be, or the hype of going public? What's more, what takes center stage with that?
Yeah, I mean, I am a huge believer that, an IPO is a branding event. It's an opportunity for, a broader set of employees to have ownership in the company. So I do believe that. That said, I do think right now there needs to be a real goal and reason to go public. It is a cost. It is expensive. It comes with additional infrastructure. So I don't think that sort of quick trigger to an IPO is like it was back in 20 and 21. I do think companies are very much making sure there's a business purpose and that the incremental, cost of being public is worthwhile to the overall business. But, generally there's a sense that bringing incremental proceeds into the company can, help drive growth, or it's that we need to, basically enable a monetization opportunity for shareholders that have been investing in the company a long time. I mean, those are generally the conversations we're having. And keep in mind, at least 2/3 of the IPO market is coming from the private equity or the venture capital community. So they obviously have goals, which is to to return capital to LPs, and those LPs have been waiting a long time.
All right, great. Yes, time for one last one.
It, it's an interesting question. The Project 2025 proposal was to abolish FINRA and the PCAOB and to take all of the regulatory authority of the other SROs and move it into the SEC. It seems kind of drastic. So I don't know how you get FINRA to move. That's a tough one. It's much easier to replace Gensler as chair and then have sort of more of a policy of moving things along. But
The SEC gave the corporate action thing and handed it over, but the SEC has also sued DTC before. They were refusing to clear shares, they were locking up shares because they didn't like the investment lists, so on and so forth. So there's questions.
This might be something Michael can weigh in on the next panel, too. We promise we'll address this, but we got to keep moving here. All right, we're going to wrap it up there. Thank you so much, gentlemen.